Hold on tight. What the latest U.S. jobs report reveals could reshape your economic outlook. After years where job opportunities were abundant, wages saw steady increases, and consumers freely splurged using savings accumulated during the pandemic, the landscape is shifting dramatically. American workers now face a challenging and sobering reality. Finding employment is becoming more difficult, and a growing number of industries are actually cutting jobs. But here's where it gets controversial. Does this indicate the start of a long-term economic downturn, or could these changes be temporary setbacks? Just released this past Friday, the newest jobs report shows that the U.S. economy added a modest 22,000 jobs in August, while the unemployment rate crept up to 4.3%, the highest level we've seen in nearly 4 years. This data has experts like Glassdoor's economist Daniel Zhao sounding alarms, describing the job market as stalling and slowing down to what he calls a dangerous speed. Essentially, job growth has slowed to a crawl. This stagnation sparks concern beyond just unemployment figures. When hiring dries up, the ripple effects on the broader economy tend to be serious, affecting wages, consumer spending, and overall financial stability. So, what does the data really say, and where might things be headed? For starters, job growth hasn't just weakened, it's recently turned negative. Over the last 3 months, the U.S. economy has seen a net average of around 29,000 new jobs per month, according to the Bureau of Labor Statistics. While that might sound respectable on the surface, it's actually the slowest 3-month average since 2010, the time when the country was still climbing out of the Great Recession. To put it plainly, these numbers reflect an unusually sluggish job market by historical standards. Adding to this gloom, June's revised job report now indicates a net loss of 13,000 jobs, marking a rare contraction rather than growth. An important but often overlooked detail is how job losses and gains spread across different industries. The jobs report uses a measurement called a diffusion index to track employment shifts across about 250 private sector industries. When this index is above 50, more industries are adding jobs than losing them. Below 50 means more industries are shrinking. The index has been under 50 since April and stood at 49.6 in August, barely keeping afloat. Most industries either grew just slightly or shrank, with more sectors experiencing losses than gains. One of the hardest hit areas has been the goods-producing sectors. This includes manufacturing and related fields, which were initially expected to benefit from President Donald Trump's tariff policies. However, as economist Joe Brusuelas notes, the erratic and aggressive application of tariffs has had an undeniable negative impact on hiring in these sectors. Since May, goods-related industries have seen 4 straight months of job declines. Instead of boosting domestic manufacturing, restrictive trade policies have heightened supply chain uncertainties, causing companies to pull back on hiring or even downsize. On the flip side, the healthcare industry stands out as a rare bright spot. Fueled by America's aging population, healthcare jobs have continued to grow steadily and were responsible for adding an estimated 46,800 jobs in August alone. However, healthcare represents only about 15% of total U.S. employment, meaning the majority of workers outside this industry haven't experienced much positive movement. As LinkedIn's head of economics for the Americas, Corey Cantenga, explained, 85% of workers are simply not seeing many job opportunities emerge. A particularly concerning signal, what economists sometimes call the canary in the coal mine, has come from the rising unemployment rate among black workers. It increased to 7.5% in August, the highest level since October 2021. What's more, this rate jumped sharply over the last 2 months, climbing from 6% in May to 7.2% in July, before reaching 7.5%. Economist Dean Baker points out that while unemployment rates for black and white workers generally move together, Black workers typically experience bigger ups and downs. Comparatively, the unemployment rate for white workers actually dropped slightly to 3.7%. Why does this matter? Because historically, rising black unemployment often foreshadows broader slowdowns in the labor market. Black Americans disproportionately hold jobs in frontline roles, lower-wage positions, and government employment. Economists have long warned that sweeping policy changes, such as trade restrictions, immigration enforcement, federal workforce reductions, and a crackdown on diversity and inclusion initiatives, could erase recent employment gains made by women, black workers, Latino workers, and other historically marginalized groups. This raises serious issues about equity and the future inclusiveness of the labor market. So what's behind this slowdown and uncertainty? There isn't just one culprit. Glassdoor's Daniel Zhao notes that even before this year, the labor market had begun to decelerate amid already high interest rates. Tariff-sensitive sectors like manufacturing and construction have been especially hard hit, showing notable job losses. More than that, the very unpredictability of policy, whether around tariffs or other regulatory changes, discourages businesses from committing to new hires. In other words, economic uncertainty creates its own drag, as companies prefer to wait on the sidelines until they have more clarity. While 4.3% unemployment still falls within what economists consider a healthy or full employment range, a rising trend here could quickly spiral. This relatively low unemployment rate has been supported partly by fewer people looking for work, due to aging populations and fewer immigrant workers. But as unemployment climbs, that suggests the problem isn't just about worker availability. It reflects weakening demand for labor. When unemployment picks up, its effects compound rapidly and unpredictably, potentially triggering a downward economic spiral. If hiring cools further, American households will have less income, dampening spending, the vital engine that drives job creation and economic growth. A vicious cycle could form, deepening an economic slowdown. Yet, amid these warnings, it's important to note that an outright recession isn't guaranteed or even imminent. According to Brusuelas, current labor market shifts are influenced by a mix of cyclical and structural factors, especially trade and immigration policies, combined with the overarching cloud of policy uncertainty. Interestingly, there's hope on the horizon. Economists predict that a combination of interest rate cuts, tax reductions, and incentives for business investment may revive hiring and economic growth later this year and into early next. Even a small interest rate cut by the Federal Reserve could send a powerful signal to markets and businesses. As Ron Hetrick, a senior labor economist, explains, there was a burst of optimism and hiring after last year's election, and when inflation appeared to be under control, only for that momentum to be lost due to tariffs and renewed inflation fears. By lowering rates, the Fed would be effectively saying, it's time to restart the economic engine. Here's the question that might spark debate. Are the current policy decisions and market dynamics painting an inevitable slowdown? Or could a shift in approach unleash stronger growth sooner than expected? How should policymakers balance managing inflation and uncertainty without stifling job creation? Feel free to share your thoughts.